Excellent. Well, welcome everybody to my second of two bonus lectures that I do every year here in the Smith School of Business at Queens. My name's Dr. Peter Gallant. I'm one of the professors here. And I don't know if you've ever come to a bonus lecture from any of your professors before, because I'm not sure how many um uh, people actually uh, encounter bonus lectures from their professors. So, one quick caveat, nothing I'm talking about today is related to any of the courses that I teach. It's totally outside the curriculum of any of the courses I teach here at Smith in Commerce or MBA or the Masters of Management Innovation Entrepreneurship. I think one of my roles as a professor is to get everybody around us to think more. And so my job is to provoke some thought about topics that I think would be of value to you as students here at Smith or elsewhere across the university. If you're coming from other departments and faculties, welcome, and welcome to everybody on Zoom today as well. So in the fall, so this one's called what I call the Fire Path: Personal Choices Now for Financial Freedom in the Future. So guess what we're going to talk about today? We're going to talk about money. And one of the things that I've always found fascinating about how we roll here in the School of Business is we spend lots of time studying corporate finance, but we spend practically zero time talking about personal finance. And I think that's a little bit of a gap. And I think this is where I can have a bonus lecture that promotes some thinking around that idea. And so this is the goal of what I'm here about to talk about here today. The fall term bonus lecture is on productivity. And so I'm a big advocate of getting you to think about, in the fall bonus lecture, about the habits and systems that you develop to be more productive. How are you going to do an overwhelming number of things to do and still function productively with a clear head? And there are recordings of that bonus lecture floating around, or if you want to get access to it, you can email me at peter.gallant@queensudu.ca, and I'm happy to share that with you. So I'm advocating in the fall, I was advocating systems around productivity. In the winter, I'm advocating developing your financial operating system. How are you going to operate with respect to your finances in a consistent, effective way for the next 100 years, right, of your personal and professional lives? And so that's what today's about. And so I want you to think about that. Hey, what habits, what things am I talking about? What concepts could get my thinking stimulated about personal finance? And I'm going to move fast today because I've only got this room for an hour and a half. Trying to book a room this time of the year is always pretty quick. So one of the challenges is, so not only are we going to, we learned about managing commitments and in productivity. When we talk about finances, we got to figure out how to manage money and what our systems are going to be. And what I'm also going to advocate is avoiding what I'm going to call the standard financial path, right? As you're coming up to graduation, there's an interesting nexus, there's an interesting decision point there, a fork in the road, and there's a potential to head down what I call the standard financial path. And I'm going to present to you an alternative today to the standard financial path. And I wish I knew some of these ideas 20 plus years ago. It took me the last decade and a half to really get my head around and practice some of this stuff. I speak at some of the financial conferences that happen occasionally in Canada as well, and share some of these ideas. So I'm happy to do that today. One quick disclaimer: anything I talk about around investment is not to be construed as investment advice, right? I don't give investment advice. I'm not licensed to do that. And any investments you make have a risk of loss. The end of disclaimer. So let's get rolling into it. Let's talk money. What do you associate with money? How do you feel about money? Does it make you actually feel good? Does it make you feel nervous? Does it make you feel squinchy? Does it make you feel uncomfortable? All those things could be associated with money. Some of those emotions could be almost simultaneous. What did you experience and associate in childhood that may lead to your associations with money? Was it scarce? Was it plentiful? Was it never mentioned? Was it a taboo subject, right? Were or are your parents good with money, right? What environment were you exposed to around money? Are you good with money? Do you consider yourself good with money? Of all your friends, would you be the one that would be seen as the one who's the best with money? I see a couple smiles. Yes and no. And also, is money a taboo subject when it comes to talking about with your friends and family? Or can you have pretty open conversations about that? Right? And for some people, maybe it's hard to have that conversation with a friend or family member, but there are online communities, online chat groups. I do some work with an organization in the US called Choose FI, Choose Financial Independence, where people have pretty open discussions about money. And I go to some of the financial independence conferences where there are zero limits to talking about your finances. You talk about your numbers, you talk about it all, right? So, but for many of us, money is a taboo subject, right? And money is also a potential source of stress and anxiety. Data from even 10 years ago showed that most 75 to 78% of people living in the US, and very similar statistics in Canada, were living paycheck to paycheck. And that most people couldn't incur a $500 expense, like an emergency car repair, without going into debt or selling something. That's not great. And those numbers have not gotten any better in the last 10 years, right? So, debt, a lack of emergency funds, a lot of people are financially fragile. And that's a scary thing when you think of it. And the problem is that financial fragility combined with this lack of willingness to discuss finances in kind of in an upfront, proactive way has led many in society to think that financial fragility is normal. Oh yeah, it'll be okay. I get paid on Friday. Everything's gonna be great for another 2 weeks or another month or whatever, how often do you get paid? I'm going to present a contrary opinion to that, which is, you know what? If you're financially fragile, that should be abnormal. That should be a financial emergency and a personal emergency in your world. And I don't think it is for many people. And the challenge is that the decisions that you make within the next couple of years as you're coming up to graduation, you can make choices that put you on what I call the standard financial path. Or you could consider making some different choices that I'm going to put in front of you today and lay out. And you may look at them and go, God, I'm not going to do that. And that's okay. My job's just to stimulate the thinking. It's not getting you to do anything. That's up to you. That's as my 17-year-old daughter says, that's a you problem. That's not a me problem, right? So I want to put some choices and alternatives in front of you that you may not have thought about with respect to finances. So the standard financial path looks like that. Hey, I just graduated. I got a pretty nice job offer. I'm going into consulting. I'm going into finance. I'm going into some other cool job from graduating from a university with the reputation and quality as Queen's. I got a nice high starting salary. Not sure what you consider high starting salary, but I have an example in a minute. And so, I'm entitled. I got some student loans, but I'll pay them down over time. Yeah, my credit card's a little high and, not going to ask mom and dad to pay that. I'm going to pay that down over time. But you know what? I'm moving to a new city. I'm going to need a new reliable car. I'm going to lease a Tesla. Okay. And oh, by the way, I'm going to go out with my friends a lot. I'm going to be eating out a lot. I need some new clothes for work. A lot of your friends in the next couple of years will invite you to expensive exotic vacations. And all of a sudden there's going to be the wave of weddings that inevitably happen that are super expensive, right? Like a destination wedding is not a great idea if you're trying to keep your friends from going into debt. And also you're like, hey, now I'm moving to a new city and now I got this great job. I'm going to buy one of those great glass boxes in the sky. I'm going to spend some dollars on a condo and I don't want a roommate anymore. I'm tired of that from university. I deserve it. I've arrived. Okay. And so the problem is all of these things start to become the new normal and you're like the frog in the pot. The heat keeps on coming up, but all of a sudden you found yourself, now you're on the standard financial path, right? Which involves debt and involves a very heavy dependence on a continuous stream of dollars coming in practically forever. Okay? Well, let me present to you an alternative. But before I do that, I want to add a couple more thoughts about the reality of the standard financial path. Then I'm going to talk about an alternative. There's an author out there named Vicki Robin who wrote an awesome book called Your Money or Your Life. It is standard reading in the financial independence community. And she was also interviewed for an amazing documentary that called Playing with Fire. And last year, as part of the bonus lecture, we screened that documentary. Then I had Travis Shakespeare, the director, join us from LA for a debrief live. It was really cool. I may do that again because there's a new finance club starting here up at Queens. Might do that as an event in the future. So being financially illiterate makes you a pawn. Being financial literacy makes you sovereign, makes you independent, right? And protects you from some of the risks of being financially fragile, right? And so in her book, Your Money or Your Life, she talked about how buying things or spending money is you're trading off your life energy for that money, right? There's a trade-off between the time you have, which is your finite resource, and money. And one of the exercises she does in the book, which is very eye-opening and sobering, is what I call your effective wage exercise. So I don't know what a good starting salary is. Maybe I'm off a little bit because I'm old, but let's say, well, so we're going to run an example here of an effective salary. Now there is one Canadian bank that has a slogan called "You're richer than you think." I'm actually going to say that you're poorer than you think. And here's why. So we're going to trade our time and effort for money, right? And so money is equal to stored life energy. So let's say we graduate, let's say we get an $80,000 starting salary. Is that a good starting salary for you guys? Would you be happy with that? I didn't know. Maybe I was thinking 90 or 75, but let's just call it 80 and not worry about the minutia. Mom, Dad, I just got a starting salary offer of $80,000 a year. That's almost $7,000 a month. I'm getting the condo, I'm getting the Tesla, and I'm going to Florida. Okay, well, hang on. So yeah, so $80,000 a year times 40 hours a week is what they pay you, or maybe 37.5, times 50 weeks a year, only 2 weeks a year of vacation, maybe plus or minus a bit. $80,000 divided by 2,000 hours, that's 40 bucks an hour, right? No, it's not. Not even close. Think about it. Well, first of all, $80,000 a year, you don't get $80,000 a year. About 29% of it goes to taxes right off the top. Those are just income taxes, not the taxes on taxes that we pay. Like when we go and buy something at a store and we pay GST, even though there's a short-term GST holiday, we're paying 13% tax on dollars that have already been taxed at 29%, right? The highest marginal tax rate in Ontario is over 53% of your income. Every dollar you make over a threshold of around $240,000 a year, the government takes 53% of that. Taxes are your largest lifetime expense, okay? So now you're not making 80 grand a year, now you're making 56 grand a year. That's the numerator is now knocked down by 23 grand. The problem is the denominator is also knocked down. Numerator is knocked down by one other factor, and that is you have costs. You have costs of commuting, some clothing for work, bus passes or rail passes, or commuting costs of a vehicle and insurance and parking and all that fun stuff. And before and after work, sometimes you can't get home in time to cook, or you're going out for lunch with your coworkers or whatever. So maybe there's 10 grand a year worth of additional spend to be able to enable you to earn that $80,000 a year. And we're not spending just 40 hours a week as engaged with work, are we? We might have to work a little bit more than that, but also we got to get to work. We got to get home from work. We got to get ready for work. And we got to commute to and from work. So instead of 40 hours a week, we're probably allocating more like 55 hours a week of our lives to earn that 80,000, which is really 56, which is really 46 grand a year. So if I did the math now, you're making $17.09 an hour, just over minimum wage, of after-tax dollars accounting for the true costs of employment. It's a little depressing, isn't it? So maybe you're not going to be entitled to that condo and that new Tesla because your $80,000 a year job is not $80,000 a year. You're poorer than you think. Okay, so that's a little bit of bad news from Peter, but I'm not going to be bad news bears guy all day. So we have finite time. I'm going to be bad news bears for one more minute. Bear with me, then I'm going to be a little happier. So we have finite time. We're trading our life energy for money, but we can't do that forever, right? Nobody has forever. The other problem is, of course, if we have 24 hours a day like everybody else on the planet, minus hopefully 8 hours sleeping, although most of us sleep a lot less than 8 hours, minus the 10 hours of work and prep and commute that I mentioned, You got about 6 leftover hours in your day, right? Monday to Friday, maybe a bit more on the weekends. And so you have 2,190 hours a year to be, do, and have everything you want to do in your life outside of work. Because otherwise, your life becomes your work. And that's not always a good thing, right? We don't necessarily want to work to live and live to work and vice versa, right? And the second problem is we don't know how long we can do that because we don't know how long we're going to live. We don't know. Getting to age 50 and 60 and 70 is not 100% guaranteed. I lost one of my parents at age 53 to cancer. So you don't know how long you're going to live, right? So combine all those factors. Maybe you don't want to spend the next 80 years or 70 years working, right? Maybe there's other things to do. Okay. And I was at a conference a couple of years ago, and a woman named Rose Lansbury gave a really interesting presentation about, where we all get born. Where are we now? Have we achieved enough? Have we made enough? Have we done enough? And ultimately, are we enough? And that hits me really hard. I think about that a lot personally. And the most common human fears alternate generally between things that would translate broadly to not having enough, scarcity of resources, including money, or not being enough, right? Not having done the things you want to do, engaged in the things you want to do, achieve the outcomes you want to do, be the right example for your kids, all that great stuff, right? So people question whether or not they're enough, and money is tied into that, right? In terms of your ability to have enough, but also in your ability to enable yourself to be enough in other ways. Okay, so there's a lot of interesting emotions tied up in money. The other problem we got is we got social media, right? And I went and grabbed a screenshot. There's a Facebook content creator called the Practically Perfect Family. Every picture on social media is a beautifully staged picture in beautiful clothes in beautiful places. And they've got a bingo calendar going back to Cali, Adventures by Disney, stand on a Broadway stage, see Wicked on Broadway, work with, I don't know what 200K is. I don't know if that's 200K followers or 200K with a dollar sign. There's no dollar sign, right? And also people project a very carefully managed image on social media that they're all happy and skippy. And secretly, that's not the case for very many people. They're scared about their financial future. They're worried about not having or being enough. So I think we got to start ignoring what the image that are projected about how well people are doing financially on social media, because it can make you feel like shit, right? It makes me feel like shit once in a while, and I avoid it. So I don't want you guys feeling like shit about it. Okay, so here's the reality. So the standard path has a couple of other challenges associated with it. If you spend all your money on those wonderful condos and Teslas and eating out and drinking out and expensive vacations and wedding and all that stuff, you might spend every dollar you make. In other words, your savings rate could be zero. If you don't save any money, the length of your working career is infinitely long. You will be continuously dependent on a stream of income. And as soon as that income shuts off for whatever reason, you are in Barney Rubble trouble, right? That's not a good place to be, right? The average North American savings rate is 5 to 7% of income. It would take 58 years at saving 5% of your income to be able to replace your income by your investments that you would have saved up with. Right? So the length of your working career, if you only save 5% of your income, is about 58 years. You guys are in your 20s now, that means you're going to be working till you're 80, right? And you're having to earn income. That doesn't sound too fun either, right? Then there's a book years ago written in the 1980s called The Wealthy Barber by David Chilton. It was quite famous. He's now appearing on, I think, once in a while he promotes financial products and banking or whatever. And his advice was save 10% of everything you earn. Pay yourself first. If you take his advice, you're above the average savings rate of a North American. Congratulations. The length of your working career is 51.4 years to save up enough money to replace your income. Remember, this is assuming you've invested that money at a reasonable rate of return. It's going to take you over 50 years to build up enough assets at a safe withdrawal rate to be able to replace your income. So the standard path of relatively low savings rates and high expenditure rates is sets the scene for what I call financial dependence. Maybe not a great place to be. Okay. But the standard path is not the only way forward. I'm trying here to make you think about things. I'm here to tell you the standard path is not the only way forward. And you could do something different. You could sit there and go, you know what? The standard path is probably not the way I want to go. And instead, I want to look at some alternatives right from the beginning that get me off the standard path. It's going to close the door for noise control. So let's do something different. If you find yourself in a hole, stop digging. Go do something different. So what's the difference? The difference is based on a simple yet interesting realization, and that is the one factor that determines whether or not you can become financially independent, the one number, the one parameter, is the percentage of your income that you can save. Right? I gave examples of saving 5 or 10% of your income. That number alone determines how long you would have to contribute and build up a stash of cash to be able to replace your income with the proceeds of that investment from the stash of cash. That's the only parameter that matters. You can do the math. So here's what's interesting. Instead of 50 years on a 10% savings rate, if you can save half your income, you can replace your total income in 16.6 years, which for some of you in your 20s means that you could be financially independent and do whatever you want with a constant income source paid for by your investments before you're 40. Some of my friends retired in their early to mid 30s, right? Even the word retirement hooks people. I'm going to talk about that in a minute. That's the second part of today's session. So everybody get that? If you save half your income, you can replace all of your income with proceeds of investment in 16 and a half years. That is the shockingly simple yet amazing math towards financial independence. It's because compounding, Einstein's right, it's one of the 7 wonders of the world, compounding interest. Returns on your investment, earning more returns on your investment are very powerful, right? So that puts you on the path to what I refer to, and many people in the financial community refers to as FIRE, if you've heard that term. Financial independence, retire early. Now the FI part, financial independence, is different from the RE part, retire early. I did a keynote 2 years ago at one of the early financial independence conferences. Rob Carrick, who writes the Global Finance column, he and I were doing keynotes, right, one after the other at this conference. And I said, FI and RE are 2 different things. And you don't have to do the RE part. You don't have to retire early. But I would advocate getting to financial independence. That's a great approach. That's a great goal to have, right? Is to get on the path towards financial independence. What you do with it, whether or not you retire, I'm going to show you some alternatives in a minute. And some of them are pretty freaking awesome. And in fact, this is the strategy that I used. I'm actually going to be pretty self-disclosing. I'm going to show you not only the strategies that I use to achieve FIRE and the financial systems that I use, I'm actually going to show you what I invest in, right? So you see a lot of stuff. Okay. So financial independent, early retirement. Most people who are on that path save 50% or more of their income. And you're going, Peter, how the hell are you going to do that? Look at today's economy, how expensive everything is. I'll show you some strategies. You invest that money in simple investments. Not crypto, not trading stock options, not day trading, right? Be careful with things like real estate because that's not passive investing either. That requires some expertise. And the reality is you grow your investments until they represent 25 times your annual expenses. Once you get, so if you needed 40 grand a year to live, you'd have to save up 25 times that or $1 million. Once your stash equals $1 million, the inverse of 25x is 4%. And so if you save up $1 million, you can safely withdraw 4% of that adjusted for inflation every year you start withdrawing, as long as you maintain the underlying investments, no matter if the market goes up or down, you are highly unlikely to ever run out of capital. 4% is a safe withdrawal rate under a huge variety of economic conditions, back tested by the returns of the stock market in every year, in every combination, order and sequence of returns, negative and positive, since 1920. It works. And I'm going to show you some of the testing methods we do to verify that. So now, all of a sudden, the magic is you build up some cash and you can withdraw 4% of that forever without ever drawing down the principal. That means you might have some money to pass along if you exit this world early, but also it gives you tremendous flexibility. So we're going to focus on building the stash. That guy in that picture is a guy named Pete Adeney. He blogs at mrmoneymustache.com. I went to grad school with his sister. He's a Canadian originally, moved to the US, has gotten quite famous in the US as an early retiree. And he and I have been at a couple conferences together. Great guy. And really has some interesting writing. He's not blogging as much, but he retired at 33, 32 years old. And he's been retired now for well over 15 years. No worries at all. But something magic happens when you retire early, by the way, and I'm going to tell you about that in a second. Well, I'm going to give you a little hint. When you retire early, if you do it right, you don't even need the 4% rule because you actually still end up making money. You just don't have to work for it as hard, right? Okay. So you might be able to free yourself from the requirement for full-time work in the next 15 to 20 years. And the retire early part's optional. The financial independence part's the cool part. And what could you do is you build up the stash of cash. The stash you don't have to wait till you've saved up $1 or $2 million, 25 extra expenses, for the stash to start helping you. As I started building up my stash, probably about 15 years ago, I was running startups, doing other entrepreneurial things, but I always was very careful to save money and keep some money in reserve. And so all of a sudden, the first thing that happens is you start to save money, is any debt you have, you can pay off. So you're free from debt, right? Some people going to financial independence still maintain a small mortgage. I do, because I'm paying 3% on my mortgage right now. So I got a long-term mortgage when interest rates were low. And I make more than that by keeping that money invested in the stock market, on average 7 or 8%. So it's worth doing for me, right? But even being kind of debt-free, you can find a job you enjoy. You can negotiate some flexibility, work from home and stuff, because you've got more financial options. You're not as fragile. And then the next thing happens, you save up 6 months of expenses in your stash, you've got FU money, right? And I'm going to drill into what FU money means in a minute. I want everybody to have FU money, right? Want to talk about what that is, seeing some puzzled faces. I want everybody to have a stash of FU money. That's a great goal. Talk about that in a second. Then, as your stash gets even bigger, your stash is now big enough that as long as you don't withdraw anything from it, it will naturally keep growing over the next 5 or 10 years to the point where you will hit conventional retirement without contributing another dime to it. That's kind of where I am. So I was in a situation where I could coast and not contribute to my retirement anymore. I have 2 kids. Both of their education savings plans were fully funded. So my older guy has graduated from computer engineering at Waterloo debt-free with money in his tax-free savings account. And my daughter will graduate from university debt-free as well, even though I also spent a ridiculous amount of money because she just went to the National Ballet School for 7 years. That's a multi-6-figure commitment that was unexpected when I did my planning, but I still managed to make it work, right? So you can coast the rest of the way. You get almost halfway, you can coast the rest of the way just on returns. So then you can start to really get some interesting flexibility. You can start scaling back your work. You don't have to save anymore. You just have to pay your expenses and let your investment returns get you the rest of the way. Wow, that's really flexible. And that's essentially what I did. When I turned 50, which is now almost 8 years ago, I stopped working full time. I had got a permanent part-time teaching job here because I like teaching so much. Right? When I'm not teaching here, I'm teaching my hobbies on the weekend. It's a big through line of my life. I worked with a professional coach for a year to figure out how I was going to stop working ridiculous numbers of hours running startups and organizations and actually designing a life that I would never want to retire from. I'm as busy now. I'm probably a little bit busier than I am because the courses I teach are pretty popular. They fill up pretty fast. But over the next couple of years, I might scale down my teaching a little bit, but it gives me time to do other things. And I'm probably going to keep operating this way for decades, as long as I'm able, as long as I'm in reasonable health, right? So you can design a really interesting life where you're not all the way to financial independence. You can coast the rest of the way, right? You can do seasonal work. Maybe you only want to work for part-time of the year, right? If I stop teaching one course, I'm freed up for almost 6 months of the year here, right? So that's really interesting, right? You can start scaling back work. Maybe you go back to your employer and say, hi, I'm not interested in working for you full time anymore, but you know what? I'm really good at a couple of my job functions. Why don't I come back as a consultant and just work with you on those job functions? And oh, by the way, you can pay me the same amount you're paying me now as a consultant, but I'm only going to focus on the things that I'm really good at. How's that? And your employer may look at you like you have three heads, and then they think about it and going, wow, if we don't agree to this, they might leave and we really need you. But you've got FU money. So if they decide to not play, go find somebody else who will, right? So that's pretty cool. And then you can go to full-blown retire early. You hit your stash amount, you hit 25 times your expenses in your stash, properly invested, 4%, which is the minimum safe withdrawal rate. In fact, higher safe withdrawal rates still work under many scenarios. You may not have to earn another dime by working ever again. And some people do that, right? But one of the little dirty secrets, anybody who's driven and smart and motivated enough to get to financial independence keeps doing interesting things after they're done. Their chances of all of a sudden switching modes from earning and saving to spending and drawing down at 4% is so foreign to them. It's like driving down the highway and then putting your car in reverse. Nobody really does it that way. They end up doing part-time things and they still end up earning money, which simply contributes more to the stash and in fact makes the safe withdrawal rate even safer. Now you're building a financial plan where not only have you eliminated financial fragility, now you've actually got multiple levels of safety to your financial plan. You're now building yourself a real financial plan. I want all of you to have some sort of financial plan. So I want to talk a little bit about FU money. And that, as I mentioned, this is where I am with Coast-Fi and semi-retirement. Best decision I ever made. Best decision ever. So FU money. Everybody knows what the F stands for, right? So all of a sudden, you got enough money saved up for six months of expenses or more, maybe a year of expenses. Your employer decides and says, oh, yeah, you're going to have to work more, or we're going to change your hours, or you're no longer able to work remote. You have to commute to your job 5 days a week and that was never part of the original deal when you signed up, right? You can go, you know what? I'm not interested in doing that. F you, right? You're in a bad relationship with a romantic partner or a roommate. F you. You have the money to get out of that. You're not going to be trapped in that relationship, right? And anybody telling you to do anything you don't want, F you. You don't have to do it because you don't depend on their money. You've got reserves, right? So I want all of you to save up FU money. If you want to see some funny clips, which if we have time and I stop the recording, they're not really safe for work because they use some language in them. If anybody's ever watched a movie called John Goodman's The Gambler, right? They've got a reference to FU money. That's kind of where the reference came from. And one of the leaders in the financial independence community, J.L. Collins, who wrote a book called The Simple Path to Wealth, he and a group of people actually refilmed that scene and cut in Marky Mark having the conversation with him like the real movie. And he talks about FU money. So that's good. There's also an article. I'll post this or make sure at least you can get the link. And you can also read some articles about why FU money is so valuable. So you don't have to wait until you've saved up 100% of your target savings to start benefiting from being on the path to financial independence as opposed to being on the standard path, right? Yeah. No, you actually, the FU money is just when you've got maybe 5 times your expenses or 2 times your expenses, you have FU money. In an emergency, you could draw from that money if you needed to tell somebody to FU. But then later, as that money grows, then you already always have built-in FU money. So it kind of is cumulative, okay? But then here's some of the standard pushbacks to this way of thinking. But I like working and I like my job. Well, your 20-something self, when life is all adrenaline, right? And you can, get to bed go home from the bars at 3 a.m. and still be at work by 7 and feel fine. That doesn't last much past your 20s. Just starts to break after 50, the warranty's off, right? So the reality is you might like your current job, the 20-something version of you, but the 30-something version of you that's now had kids or has gotten married or whatever else, you may not like that job. It may not be fun for it to be all adrenaline 24/7 anymore, right? So that's not too good, or maybe you end up getting laid off. Some people do. I wouldn't know what to do with myself if I retired and do nothing. You can do whatever you want. Nobody who follows this strategy sits there and does nothing after they retire. In fact, if you retire and do nothing, that is a very dangerous situation to be in, right? One of my parents tried that. Just stopped working cold turkey at 65, died. So not a good idea, right? So we're made to work at some level, but work doesn't mean always paid work. Go and do things you're interested in. Go and volunteer. Go and wash dogs at the Humane Society. Do whatever you want. Go walk cats on leashes. That's good. That'll be challenging. They don't like that. Tried to walk my cat on a leash. He didn't do it. I tried to walk my rabbit on a leash. He wouldn't have any of that. So when I had furry pets. And so, do whatever you want volunteer-wise, right? But you freed yourself up to do whatever you want. Then the challenge becomes defining what that is. That's why I worked with a coach for a year. I had a list of projects I sent her, right? I had so many ideas about what to do when I stopped working full-time. She said, this is insane. Like, we got to cut this down. You got to come up with a plan that is viable and is not just you trying to feel like you're not enough, right? That's where a lot of that came from for me. I wanted to do this and I want to do this and I want to do the whole one. What do you really want to do, right? You are enough. What do you want to actually do that you're good at, that you enjoy? And we narrowed that list down. Took a year. I'm that stubborn. Okay. Even partial financial independence. The way I think about it is, even if you went to part-time work or semi-retired, worked on a couple of projects, some of it would be paying work, you free yourself up to do just the best work you can do. You don't have to do all the other things that you're not so good at. You can balance work with other aspects of your life, right? You can earn money efficiently on your own terms, right? So when I go into consulting mode, I'm not earning $50 an hour, right? So I can charge fairly high consulting rates at my age and stage that actually make it quite financially worthwhile to spend a couple of hours consulting, right? And also you get rid of all the job-related bullshit. Commuting doesn't happen in my world. My longest commute's 17 minutes from here to the east end of Kingston, right? I live in the country, but I can still be here in 17 minutes. If a client wants me to travel, that's all totally up to me, right? Deadlines, I don't really sign up for very many deadlines except for a small number that I have with respect to the teaching I do here. Do I have to bring my laptop on vacation? I do, but I don't have to. I do it because I like working a little bit when I'm on vacation. So you got a lot of freedom there, right? So even moving partway towards financial independence doesn't sound like a bad idea. So I got about half an hour left. Now let's talk about some of the nitty-gritty. I'm going to move pretty quick. I've set the framing. Let's not take the standard path. Let's think about alternatives. Let's think about financial independence. Let's think about early retirement. I'm not going to say much more about early retirement, but now how are we going to get there given how expensive the world is? How are we going to make the math work? Because financial independence is primarily about math and making the math work. Well, there's a couple of strategies that I'm going to share with you at a high introductory level because I've only got half an hour. And then you can think about them. And if you're really interested, start drilling into them. And most importantly, if this stuff is getting you interested, go start doing this stuff. Right now, I'm going to leave you with a 6 or 7 step call to action at the end of this today. So again, you calculate your annual expenses or any projected expenses where you're going to be in a couple of years, multiply that by 25, and you probably need to save up at least $1 million, probably in this world, probably closer to 2 these days, considering how expensive things have gotten. But remember, whatever you save up, A 4% safe withdrawal rate is pretty safe. 4% is actually a very conservative exchange rate or a withdrawal rate. In fact, the sustainable safe withdrawal rates are actually over 6% based on the performance of the stock market. The risk is you start drawing 4% on your stash, and that coincides with a couple of years in the stock market where the market loses 10 or 20%. Well, you don't sell, you don't get out of the market because that's disastrous, right? You stay in the market, but it's going to take a while for the market to recover. So we model sequence of return risk to see if that combination of bad returns plus drawing 4% out, does it ever draw you down to zero? And the answer is almost never. You have almost 100% certainty at 4%, right? Remember also, the retirement community, the conventional retirement community will say, work till you're 65 at least, and you have to save up $3 to $5 million to retire comfortably. That's crap, right? You run the math yourself, right? Now, if you retired and did absolutely nothing and you needed like long-term care at 60 because you've trashed your health, yeah, well, maybe you need $5 million a year to retire. But if you go and coast or you do some semi-retirement, earn a little bit of income, right, you're going to have a fairly safe retirement, well below what some of the financial advisors and banks are telling you that, because not only you can, yeah, you go from accumulating assets and savings, building the stash, you're going to start drawing it down, but it's all of a sudden going to go flying down to zero. And in fact, most retirement scenarios, you could live to 90 and you would still have some percentage. In this scenario, one scenario, 100% chance of success, you withdrew 4% for almost 40 years of your original stash of cash. You saved up to, this one was at 1.5 million. You then switched to withdrawing 4% for 40 years, never contributed another dime, never had any other sources of income. And after 40 years, when you were freaking 90, you still had on average 317 grand left in the stash. And in some cases, the stash has gone to over 2 million, depending what future returns are. And yeah, you can leave that to your kids, but you know what? You leave too much money to your kids, and I don't think that helps them, right? So, you know, that's something that, you know, I don't know if I would aspire to be leaving huge amounts of money. There is a book called Die Broke or Die with Zero. I don't know if I'd want to follow that strategy either, but somewhere in the middle is a happy medium. So now back to this famous chart where we said, hey, the average savings rate in the US is 6 or 7%. There's our 10%, you know, wealthy barber. Remember, that was still going to take us 50 years. Peter, how the hell are we going to get down to a savings rate of 50%? Well, you got to go in increments. When you first get your job after you graduate, at least try your absolute best to save at least 10%. Configure your life based on your salary after tax and after employment expenses that you can still retain 10%. If you can't do that, then there are some strategies we're going to have to use. If you're working for a corporation, you're probably going to get a 5% employer match, right? Like if you would contribute 5% towards your retirement, they contribute another 5. Well, now that still contributes to your savings rate. It still builds the stash. It just happens to be in a retirement account. So that might give you a free 5% right there. So now I'm at 15 already. I haven't done anything but just made sure I'm not spending more than I earn by some reasonable margin. And I signed up for the employer match and signed up for the retirement plan as soon as I started with my employer. Then I started to minimize my housing costs. Yeah, you're not going to live in a really nice shiny condo alone for the first couple of years after you graduate, right? Live like you're in university still a little while. Minimize some housing costs. Share it. If Airbnb is your thing, maybe you have a property that you can Airbnb, right? So you can minimize housing costs. That's one of what we call the big three: housing, transportation, and food. Have a huge impact on your budget. Your savings rate can be up well over 20, if not 30%, with a proper living arrangement, right? Don't spend $3,000 a month on a downtown Toronto condo on your own. Don't need to, right? So don't buy a car. My son's 24, lives in Vancouver. He has a roommate. He doesn't own a car. No interest in owning a car. I own a 12-year-old car. My wife's car is even older than that. They run fine with a bit of maintenance, right? I'm up to almost 370,000 kilometers on my car. I don't need a new car. I don't care about cars. I spend on stuff that I care about. I don't really care about cars. I did when I was in my 20s. I drove an RX-7 and all that great stuff, but I don't care about cars now. So guess what? Save some transportation costs. So start taking out the big three: housing, transportation, and food. And so all of a sudden now we're starting to get our budgets under control. And then eat at home once in a while. Not every time, but learn to cook. Learn to prepare meals. Prepare a batch of meals on a Sunday that lasts you a couple of days. That last of the big three of housing, transportation, and food can get you the rest of the way. Or at least you're getting pretty close to 50%, giving it the old college try. Good for you. Now you're on the path to financial independence. You're not on the standard paycheck to paycheck path. That's going to start paying off immediately. That's just awesome. And then if you want to really go for it, this is the bonus round. Try to figure out how to get your savings rate to 70%. How that usually happens is a combination. Expense control only gets you part of the way. You've got to start dialing the other dial that you have control, a little bit less control over. That's your income. Dial up income after you've dialed the shit out of your expenses. Make sure you have efficiently done every expense. Spend money with an eyedropper. Review subscriptions. Review cell phone plans. Review everything, right? Make sure your expenses are as low as you can and track where your money's going. That's one of the strategies I'm about to talk about in a second. So to actually build the stash, the savings, you have to create what we call in financial independence the gap between income and expenses. You've got to create the gap, grow the gap, and guard the gap. Growing the gap means minimizing expenses, dialing up the revenue. That creates that gap between earning income and expense that creates those percentage savings rates, right? But then here's the other trick. You've got to guard the gap. You get a raise at work, you get a 10% raise, do not increase your expenses by 10%, right? Don't instantly go and lease the new car or start spending more eating out. Hold your expenses down a little bit, right? You won't care. Even if you go and step up your lifestyle a bit, hedonic adaptation, you're going to hit the same level of happiness you were at, right? You'll just get used to a new normal that's more expensive. So don't do that. Guard the gap and try to keep that gap growing. Increase your savings rate. Measure your savings rate. And what I do, I use budgeting software even today. This morning, I reconciled all my bank accounts and I manually type in every dollar I spend. I don't even link to bank accounts where it can automatically import transactions. I type in every dollar I spend. You know what? Actually, that gives you incredible awareness where your money's going, right? Like incredible awareness. Oh man, why did I spend like 61 bucks at a place for 3 shitty tacos that I didn't really like anyway, right? So it makes you think about it a lot, right? So being aware of where your money's going, and then if you're truly budgeting, not only are you aware of your money's going, you're setting a budget limit. And when you hit that limit, if you're out of eating out money for the month, you're not buying shitty tacos for 60 bucks. You're doing something else, right? Until the end of the month. So some people expense track, but some people truly budget. So I use this piece of software called YNAB, You Need a Budget. I bought it almost 20 years ago when it was still a spreadsheet from Jesse Meekum, who invented it. He's doing quite well on it now. It's an annual subscription fee now. But I think as students, you can go and get a free subscription when you're a student. So there's a process to do that. I think it applies in Canada. I'm not 100% sure. But if not, email me, let me know I can ping Jesse and ask him. So that will allow you to scrutinize every expense. And YNAB has 4 rules, of which one of them is give every dollar a job. Every dollar coming into your world needs a job. This dollar is assigned to help pay my cell phone bill. This dollar is assigned to paying my property taxes. This dollar is assigned to building the stash. Every dollar has a job as soon as it comes in. There is no unbudgeted money. Unbudgeted money just tends to evaporate into spending that we didn't really need, right? So I use my budget every day and I track all my expenses that way. But there's a limit, as I mentioned, there's a limit to how far you can dial down expenses, right? The other thing you can do is dial up your income, but I suggest dialing your expenses down first. And what savings rate can you hit by dialing down your expenses? My son moved to Vancouver, has a pretty good job as a software engineer. He's over 50% savings right now. That's my question to him every month. What's your savings rate like? Well, I'm over 50 now. I'm probably closing in on 60. Great, right? So keep that going. Every year you do that, the better off you are. So, but at some point, there's a limit to how low you can drive your expenses. Then you have to start adjusting the other dial, income. One thing, first of all, negotiate your starting salary. If you've got more than one offer, don't play them off against each other, but come back with a little bit of a push. The higher your starting salary, that's the salary that gets exposed to your annual percentage increases, right? So it's cumulative. So it's better to start high. The other trick is within the first 5 years, I want you to consider leaving your job and getting another job in the same industry. It'll be a little bit of a promotion. On average, people see a bump in salary of 20 to 30% in that job transition. And then all of a sudden, now your new salary is what you're getting your annual increases on. But most existing employers don't give you more than a couple of percentage points annual income increase. If you want that big bump, you've got to do it by a salary bump. Quick question, because I'm running out of time. But yeah. Just a job switch in some cases. Maybe you go to another employer in the same industry. So look around, maybe go and quietly interview for some positions. And if you can get a 20% salary boost, guess what? Your savings rate just went up by at least some percentage of that 20%, right? You do it once in the first 5 years, and then all of your increases are based on that new higher salary. So that's the first thing. The second thing is a side hustle. Everybody heard that term before? You might be required to work full time, but on the side, can you actually build up a side business? If you're really good at graphic design, can you build an Etsy business that sells printable Etsy things or arts and crafty things? Or can you do some web design on the side? Start earning a little bit of side hustle money, right? Or become a content creator online, company of one type stuff, right? And you can start building a side hustle. It may take a year or two, but the good news about side hustles is if your primary job pays all of your expenses, side hustle money is pure profit, right? So it can go right to building the stash. So that's really valuable, right? So pet sitting, house sitting, food delivery, consulting, tutoring, helping old people shop, blogging, Etsy, you name it. Think about side hustle income. Because once you got your base expenses covered, it goes right to the stash. And then every dollar in that gap of money you can save needs to get swept out of your checking account as part of your financial management system. What do you do with that money, Peter? You sweep it the hell out of your checking account into a series of investment accounts that I'm just about to show you, and you invest it. And again, some people like day trading, some people like picking individual stuff. I did all that. I traded options and futures on the Chicago Board of Trade, Chicago Mercantile Exchange, leverage trading, you name it. I've done that kind of trading. You know what the easiest thing to do is? Invest in the S&P 500 index. The 500 largest companies by market capitalization in the United States of America. That's 500 CEOs and millions of employees working every day to make you richer, right? And you don't have to do anything. It's a number sitting in an account. You're not owning a property where the tenant's calling you at 3 a.m. saying the toilet doesn't work or the heat doesn't work, right? You don't have any, it's hands off. It's passive investing. You don't even have to pick a stock. Once a year, I look at my portfolio just to see how it's doing. I can monitor it more often than that. I watch the stock market go up and down a bit, right? You know who performs the best in a stock market when it goes up and down and is volatile? Dead people. Why do dead people do so well in the stock market? Because they don't trade, they don't sell, they don't panic because they're lying there dead. When you're dead, you can't call your broker and panic and get out of the market. When you're lying there dead or ashes and all burned up and all that fun stuff, you can't panic when the market goes down 35% in COVID. You're dead. You do nothing. You simply hold your investments and you never sell. That's cool. 100%, almost. I'm going to show you on the next slide. I keep a little bit as a buffer, as a strategy, but other than that, 100% invested in the stock market. I don't need any bonds, right? Because I've still got a 15 to 20-year investment horizon, right? I'm going to keep working and offset my expenses. I don't need to draw down. I don't draw down except for some ballet school expenses that have kind of beaten me up. On an average year where I don't have a daughter going to the ballet school, I will have zero drawdown requirement. When you don't need the money, keep it fully invested in equities. You can survive the volatility. I'm going to show you that in a second. Also, the S&P 500, if you go to Vanguard or one of the other exchange-traded fund providers, do not invest in mutual funds. Bank mutual funds, if you ask them, they will have to disclose to you that they have expense ratios where they take 1.5, or 2% off the top every year. That murders returns. If I started with the same amount of money, zero, and I invested $6,000 per year and earn only 5%, which is less than the average return on the stock market, here are 3 different portfolios. And the only difference is this portfolio in 40 years, got almost $800,000. This one, $180,000 less, had a 1% management ratio. And this one, another $150,000 less, had a 2% management ratio, 2.4. So when they only say, oh, it's only 1.1% management ratio, that comes off the top every year, and that, draws you down every year. That's terrible. They're not even doing any management. They're buying the S&P 500. They're just buying the stocks that represent the S&P 500. Vanguard's management ratio, 0.08%, less than 0.1%, just to cover their transaction expenses, right? It's essentially operating as a not-for-profit. So Vanguard has exchange-traded funds that are traded on the Canadian exchanges. You don't even have to pay US-Canadian exchange rates that still fluctuate only with the US dollar if they're the Canadian hedge versions to protect you against Canadian US dollar fluctuation. I actually unhedged last year. I felt the Canadian dollar was going to go down, so I removed my hedging by switching funds. And of course, I've made more money that way because the Canadian dollar's dropped 5% in the last year. So anyway, so you invest the savings in a low expense fund, hands off, don't think, don't sell it, play dead, and just keep contributing to it. And you don't give a shit if it goes up or down in the short term. You don't feel instantly poor if it goes down. It's going to recover. The stock market always recovers. In fact, you know what happened on the S&P today after Netflix gave its record earnings announcement? It hit a new all-time high today. So when the market's down 35% during COVID, you think of days like today, a couple years later, where now it's carving out new highs, right? So I'm getting richer every day, even though I'm not participating in the market, right? So that's good. We've already talked about designing your lifestyle to accommodate the big 3, so I'm not going to belabor that too much. Any debt more than 5%, pay it down as soon as you can before you start investing. But if you got low debt, like you've got a couple grand of student loans at 2%, okay. Some people say wipe that out. I say if it's less than 5%, just pay it off as quickly as you can. But don't let that delay you investing in the stash, because you want that compounding in the time, right? So don't pay down loans and that delays you from building a stash for 5 years. The stash needs the time value of money. It's too important. The compounding you're giving up is too important. How does the Peter financial operating system work other than that? You need 5 accounts. You need a checking account, no fee. We don't spend any money, right? I have a really low fee account at another bank, because I bank with them a long time. But otherwise, I have a no fee account from Tangerine or somebody else. So you're not paying any bank fees. That's where your paycheck gets deposited, side hustle income gets deposited until it gets serious. I have an incorporated corporation for some of my side hustle income, because my side hustle income is now 5 figures. So I don't pay personal income tax on that, because otherwise 53% of it goes to the government. You have a credit card. I have more than one, of course, because if you're traveling, if you lose it or it all of a sudden doesn't work at a merchant, you want 1 or 2 backup cards. But I never use my backup cards, very rarely, maybe once or twice a year to keep them alive. My primary credit card is a rewards card. It earns either hotel points or airline points or some sort of reward. I happen to save up Aeroplan points, although that program is not, every year they make it worse and worse and worse. They devalue points. But I haven't paid for long haul flights personally for years because I put every expense through that. Buy a coffee in Goods Hall, Visa. Buy breakfast in the morning on the way into Queens, Visa. Pay as much expense as I possibly can on practically anything, Visa. So you rack up $40,000-$50,000 a year in spending. You get a points multiplier of 1.5 or 2. You have 100,000 or more Air Canada points. That's going to give you a couple flights, right? So you use expenses to earn credit card points and then pay off the credit card every month. So you pay no interest, and all of a sudden you can offset some of your travel and fun expenses or convert those points to gift certificates, right? There's some other good points programs you can participate in, like PC Plus, not great at Loblaws, but really good at Shoppers Drug Mart. Buy on the 20 times point days and redeem on the redemption bonus days. Pretty wild. It translates to about a 30% reduction in all of your drugstore expenses. You have a taxable brokerage account. In other words, that just holds investments that has no tax advantage to you. You need that because your stash is going to overflow your other accounts. You need a tax-free savings account. That is the most magical account on the planet, is the tax-free savings account, right? I think it's called a Roth IRA in the US, but here it's called the TFSA. Once you turn 18, you start unlocking contribution limits. And when you invest money, it's after-tax dollars, which I'll explain in a second, but the money builds up tax-free and withdrawals are tax-free. That's magic. That is freaking magical. So a TFSA is a high priority, right? And then a registered retirement savings plan. If you get a company pension, your RRSP contribution will be reduced by a pension amount, but it's still worth having one as early as you can, right? We'll talk about why. Plus, you need a budgeting tool, YNAB, Mint, Quicken, Personal Capital, whatever. I want you to track your expenses, create the gap, and then when there's excess money, there's the budgeting rules of YNAB. If you go to the website, you can read about them. You're saving money, reducing your expenses with travel awards card, rebate cards, store-specific cards, PG Plus, Canadian Tire, pay off the cards every month. How does the day work? How does your monthly activity financial operating system work? Your main paycheck, any other income goes into your checking account. All your expenses come out of you've budgeted down to zero expenses. All your expenses are laid out in your budget, and your budget should still have some money, which is your gap amount, that you can sweep into, allocate that into your various investment accounts. And then you go around spending for the month according to your budget, or at least tracking your expenses. And at the end of the month, guess what? Your bank account is not going to be zero. Your bank account could have several hundred to several $1,000s in it. That's magic. You actually are letting money sit that you're not spending. You're not living paycheck to paycheck anymore. You're off the standard path. So now what you're doing is you're monitoring. Once you've given $1 a job, there's guilt-free spending. When I go and pay my cell phone bill with money I've already budgeted, that's fine. That's what that money is, its job is. So I don't feel bad at all for spending all of the money I'm spending every month because it's been carefully budgeted to things that I care about. And those expenses have been absolutely minimized. I'm with Public Mobile. I redo and resubscribe to data and cell phone plans every month. I'm down to like $30 a month or something like that, right? So, and every time there's a promotion like Boxing Day, I get that too and hammer down my prices. So why waste money, right? Be just efficient. When you're budgeting, you can see where your money's leaking. And you move, if all of a sudden I want to spend some money on something else, maybe I want to go out for a nice dinner and my budget's running short, maybe I'm going to reduce a category in my hobby category or something, right? So you take money, we call it whack-a-mole. You take money from one budget category, move it to another. At the end of the month, you pay your credit card off in full because all the money's been budgeted for. The money, the way YNAB works, the money is sitting in your bank account ready to pay your credit card at the end of the month because it's already been accounted for. You just have to move it from the credit card that you spent it on. You take money from the checking account that has the cash that just zeroes out the credit card. The budgeting already happened. So there's no credit card debt. It doesn't build up because if you overspend, the system instantly tells you you're overspending, and overspending is going to result in credit card debt. And at the end of every month, the magic's going to happen. You're going to have several $1,000s sitting in your checking account. What do? You transfer it to a series of accounts, right? Your RRSP, your TFSA, your brokerage, or if you have kids as soon as they're born, start a registered education savings plan. Literally, my RRSPs funded my kids' university, especially my older guy. So that's possible. Some people have over $1 million in their tax-free savings account. And there was an article a couple months ago in the Financial Post speculating whether or not we're going to see somebody who has $100 million in their TFSA. You can imagine living off 5% dividends on that. You could take out $5 million a year tax-free. Even $1 million, you could take out 50,000 or more a year tax-free just on dividends. Like it's amazing, right? To take out $50,000 a year tax-free, you'd have to earn $100,000 a year almost because of taxes, right? So this is the way I do it graphically. Here's my sweep. It's a series of, I think of it as a series of buckets that are connected by hoses. I sweep my monthly dollars, and the first dollars go into my RRSP. So January, I'll be making RRSP contributions this month and next month until I've reached my RRSP contribution limit, right? And every year you can log on to the CRA website. It's about 18% of your income up to a cap. So after a couple of months of contributing to my RRSP, I've now reached my limit. I then go, okay, well, that bucket's full. So now I'm going to overflow to priority 2, which is funding my TFSA. But what I also do is in April, when I file my tax return, I'm going to get 30 to 50% of my RRSP contributions back as a tax refund. And that tax refund goes and helps top up my TFSA as well until it's full. And then when both of your tax advantaged accounts are full, RRSP and TFSA, then you put all the rest of it in your taxable brokerage account. Remember, these are just accounts. You still have to invest the underlying. Once the cash hits your RRSP, it doesn't mean it's invested. You have to go and buy the underlying investment now. So I buy the exact same investment in each of my accounts. And you might come up with an investing strategy. Some people go 80% equities like stocks and 20% bonds to kind of smooth the ride. I don't believe in that. I think that just reduces your return, but your mileage may vary. You might go as high, you're young, go 100% stocks, expect some volatility, right? But maximize your returns. In my particular world right now, if you looked in every one of my accounts, each account has 3 lines in it. Cash, just in case there's any dividends that get paid. S&P pays a dividend, about 1.8% every year. So every quarter, I get hundreds, if not thousands of dollars in dividends. They sit there building up my cash balance. After a while, I might transfer some of that into a money market fund, although I don't keep 10% anymore. I keep a little bit less than that. And then all the rest, plus all the money I'm contributing, every month, I just go and buy either VSP on the Toronto Stock Exchange or VUN or one of the other Vanguard exchange-traded S&P 500 funds. One transaction, usually very low to no brokerage commission. Well, simple, I think you can buy them for $0. I pay a couple bucks, I think, at Scotia iTrade. I just like the way their system works. And you buy. And you zero out the cash, or you keep your minimum cash balance. You just keep on buying these little units. And every time you buy a unit, it's like a little soldier. That soldier pays 1.8% every year of cash, and it keeps going up in value, making you richer because it represents the labor of millions and millions of people working in the 500 most valuable companies in the most viable and accelerating economy in the world, which is the United States of America, right? I don't live there. I live here, but I invest in America because that place is growing. Things are happening there, right? So here's the other neat part about the stash is the time to get to your milestones. So if you invest 10 grand a year, if all you're able to save is 10,000 bucks a year and you're earning roughly 7% per year, it's going to take you 7.8 years to earn the first 100 grand in the stash. And the 100 grand is your goal. There's a woman who became a famous blogger, her first 100K. She talked about her strategies to get the first 100 grand in there. She's a great speaker, by the way. I've seen her at conferences. Well, you know what the neat part is? Now that 100 grand is earning a return, and now your contributions are having less impact on your balance than the returns are from the stash. And so the next 100K only takes 5.1 years. And it's so on and so forth. I'm living somewhere in the middle here of my primary stash account. And between 500 and 600K on average takes 2 years. And at some point, the impact on the stash of your contributions is far outweighed by the fact that if you were in 8% on a $900,000 stash, that's 72K of your 100K to get to $1 million is just from the returns on your investment. So the stash, every 100K becomes easier to get. So you establish that savings rate aggressively, get to 100K, the next 100K is going to be easier. The first 100 is the hard one. But once you get your systems in place, once you're used to investing, now you got 100K in the stash, right? That's great. One of my kids has 100K in his stash already, in his TFSA. So now you're off the standard path. You got fuck you money, F you money. Sorry, I said the word. I'm allowed to. It's okay. We're all friends here, and everybody on the internet. Hi. But now I've got options, right? That's cool. And the stash keeps on building. Canada is actually very friendly to financial independent and early retirees. There's no minimum age to begin withdrawing from your RSPs. I had to withdraw for a couple of years because my daughter's ballet school is pretty expensive. I took that into account, took the tax implications into account, but that gave me the flexibility to send her to an experience of a lifetime that otherwise I probably wouldn't be able to afford. It was worth it. I didn't care about a dollar number in my RSP. That's just the number. Because I'm going to be working for a long time anyway. I really don't give a shit. So I did that instead, right? But you can withdraw from your RSPs any year you want as long as you pay tax on the withdrawal as income. So you can do some planning, right? But also eventually, remember, the government forces you to withdraw starting about 9% required minimum withdrawals after age 72. But you're not going to give a shit about the rules now. That's 50 years from now. Who gives a shit about that? You're not going to worry about that. Just keep building the stash in the RSP, knowing you can still draw the money out. It's not locked in. No need for health insurance necessarily. Now, it's nice to have benefits for drugs and things like that, but then you get that with most of your employers. But we all have basic health insurance. Some may argue it's not that great, and the waiting times are very long in hospitals for surgical procedures and things like that. You might want to use some of your stash money to go get a scan or go get a procedure done elsewhere in the world, right? Medical tourism, but you got the flexibility to do that, right? You can spend 6 months. Now the rules just change. I think you can spend almost 7 months outside Canada in any year and not lose your health insurance. You don't have to live here full time, right? That's cool. TFSA, you withdraw money from a TFSA tax-free. It's not part of your income for tax purposes. That's amazing. And the gains grow tax-free while it's invested. Tax-free gains, tax-free withdrawals. And if you want to withdraw, do it in like December, and then that withdrawal becomes part of your contribution room the next year. It's restored the next year. So you don't lose your contribution room. If you build up $1 million TFSA, you can withdraw $500,000 of it in a year to go and buy yachts and Lamborghinis or whatever. And that $500,000 of contribution room is restored on January 1st the next year. Holy shit, that's really good. So you can do that. And so remember, when you're drawing down, you're not going to be drawing this down for decades, but you will then draw a blend of RRSP taxable money, TFSA non-taxable money, plus you're probably going to have some money that's spilled over into just the taxable brokerage account where the capital gains are taxable, but that's okay. You're still making money, right? You got the stash, you got flexibility on how you're going to draw it, right? And the reality is you also, as long as you stay invested and don't panic when the market drops, the stash is going to keep growing. It might drop for a year or two. That's okay, right? The market dropped for 3 or 4 months. It dropped 35% during COVID. That's okay, right? Jim Collins, who wrote a great book called The Simple Path to Wealth that talks about index and ETF investing. He has an online guided meditation for when the stock market crashes. Everything is going to be okay. It's temporary. Do not sell. The market always goes up in the longer. He's got a very calming voice, right? So you just watch a meditation and do not sell. Ignore it. It's okay. Right? It's hard a little bit, but it's possible. So you have to make sure you don't sell in a downturn. So as the stash goes up, now you got some options, right? You can be flexible. You can have a side hustle. You can stop working full time. not draw 4%. You might draw 0%. You just make your expenses work enough just to pay your living expenses, and your stash keeps growing because you're not withdrawing from it. Even though it's probably going to grow anyway, even if you withdrew 4%, it would still grow. Geographic arbitrage, some of my friends do that, right? One of my friends just is building a house in Belize. She's going to live there half the year, right? Spend some time here, live in a low cost of living area for the other half the year. Great strategy, right? The other thing we don't do, we have other margins of safety. You'll notice that I have not mentioned any government assistance, including the Canada Pension Plan, in anything I've described so far. If I get CPP, which for me will be like, maybe if I delay taking it till 70, I'll probably take 1,800 a month, 2,000 a month. So will my wife, taxable. I don't budget that at all in case it goes away, in case the program goes bankrupt. But I've contributed to it. I'll have contributed to it for over 40 years at that point. It's a contribution-based plan. It's not like the government giving you money. Sometimes they take credit for it. I paid into that thing. It's not a government grant. It's not them handing me money. It's my money. But the reality is I don't budget for that at all in my early retirement calculations. It's a buffer. It's a safety limit. And if you're worried about the safety of this, there's a great blog by Mr. Money Mustache, written now almost 15 years ago, about the levels of safety of financial independence. Even when things go wrong, when you understand your expenses and you've got a stash, you can withdraw, you can survive large income losses, job losses. If things get uncertain, you can start spending money with an eyedropper, right? So you can survive these downturns. Most downturns in the market only last 6 to 12 months. They don't last decades. Look how much the market goes up compared to how much it goes down. Remember, this is not a chart of the market growing. This is a chart of the gain until the next loss. So when the market goes up, it's worth many times what it was. If you zoom out on an actual price graph, it just keeps on going up and up and up. But this is the gains versus the losses, right, in different market periods. So the drawdowns are not that deep. Sometimes they are. They were in the 1930s because of a disastrous stock market crash in 1927. But the market can drop 20, 30%, but it recovers quickly and it grows more than it drops. That's all you really need to know, right? And I'm going to leave you with two other little quick thoughts before I wrap everything up. There are strategies to protect your safe withdrawal rate that are published, that are well-known, well-researched. The yield shield, if you need to draw 4%, remember that you actually get 1.8% of that in dividends from the S&P. You only have to draw down 2.2% of your principal. If you're worried about that, switch to some interest-bearing investments that pay more than 4% for a couple of years, right when you start withdrawing. That protects you from the 4% risk of withdrawal. And there are scenario calculators that model every sequence of positive and negative returns in the stock market since the beginning of the 1920s in every conceivable randomized order and sequence. We call it Monte Carlo analysis. And you can model this $1 million portfolio. 10% of the time ends up being worth 4.5 million, even with 4% withdrawals for decades. And there is a 95% chance of that portfolio will never run out of money. And there are modeling tools. And what I do is I remodel my stash and my withdrawal rate projections every year to make sure I'm safe, right? So this is all possible. It's all math. What do you do instead? Again, you're not all of a sudden going from earning money and saving 50, 60, 70% of your income to withdrawing 4. You do other things aligned with your purpose, your passion, your values. Great article by my coach, Jillian Johnsrud. That's the person I hired for a year to work with me to design my early retirement lifestyle, right? So you can build a life that you're not going to retire from. Build something that's sustainable for you, right? Free of the requirement to continuously earn money on the standard financial path. So my last challenge to you, because I literally have a minute and I'm on my last slide, is use the time while you're still young and you're still in university. You haven't made the first couple of big decisions, good or bad, that can set you on the standard financial path. Spend some time in the next couple of months designing how you're going to operate financially. What is your system going to be? You can model it after mine or create something entirely new. Sit down with a friend or partner and say, hey, let's have an accountability partner. Let's start planning. You know, we're going to start budgeting. We're going to start doing some other types of financial planning. We're going to set some goals. Even just track your expenses, write down where every dollar goes for the next 90 days, and then add it up. It's going to be eye-opening. Did the money go where you really wanted it to go, or was there some waste there? Think about implementing a budgeting system. There's lots of budgeting software out there, right? Some of it's even free from the banks, I think, now. Start budgeting, but not just tracking expenses, but actually looking at your budget and saying, hey, yeah, I want to go out to dinner next Friday, but I don't have enough on my budget cutter. I got to move it from somewhere else. Or maybe I'll say to my friends, hey, guys, things are a little tight this month. Can I skip this week and we'll go next week? Oh, yeah, I understand that. It's fine. Friends aren't going to beat you up for that too bad if they're good friends. Calculate your current savings rate. Now, that's as if you're employed. When you're a student, you probably don't have a savings rate. But when you start getting employed, what is your savings rate? Start off at least 10%, and then use those strategies around housing, transportation, food, increasing revenue and side hustles to get there farther. Identify a side hustle that can get you there. Set up your brokerage, TFSA, and RRSP accounts. You can do that tomorrow. Takes a couple of days to set up. You can get those in place very quickly. Wealthsimple, iTrade, do some research. What you really want is no fee or low fee TFSA or ETF, exchange traded fund trades, right? Learn a little bit about what you would be investing in. Put $100 into it. Get some money. That's the stash. You started to build the stash even if you put $100 in it. Go and look in the couches of all your friends' ghetto houses, find $100 and invest it in your stash and start to build it from there, right? And start looking at your spending to find money leaks to keep on, make it a game. Start increasing that savings rate as a percentage of your income and build the stash. If you're interested in more of this stuff, here's a couple of references that you can look at as well. And again, the slide deck and or the video. I'll probably post the video to my YouTube channel. I just started a YouTube channel, so I'll probably post it on there. That's where my videos are going to live. I also just started blogging. So if you have questions, you can, I blogged before, but I just started a new one. If you have any questions, please feel free to drop me an email at peter.gallant@queensu.ca. If you're interested in some of the writing that I'm doing right now, mostly on productivity, you can go to drpetergallant.com. Thanks very much, everybody. That's what I have to say. I might have a second for questions. I'm going to make sure nobody else is waiting for the room. Cool. I don't think I probably have a couple of minutes. Any quick questions? Yeah. Yeah. So the question is, there's a home savings account that essentially allows you can save up for the home savings account. It's possible, and I think that's not a bad option. They also allowed a withdrawal from your retirement savings as well to make a down payment. You got to be a little bit more careful about that because, of course, it has long-term implications for your retirement rate of return. But yeah, you could add an FHSA for that as well. Just be really careful around housing costs because when you buy a house, you're putting a down payment down. You've still got to pay, interest rates are coming down, but not that quickly. Real estate is quite expensive, obviously, right now. And remember, when you buy a house, there's all the other costs that come with it, right? Closing costs on buying it, property taxes, insurance, and then all the maintenance and everything else that goes on. Houses can be money pits. My current house is a money pit, right? But I like it. It's on an acre in the east end of Kingston. It's got a tennis court and a guest house and all sorts of neat things. But it takes a lot of maintenance, right? So, but it's a little kind of a retreat. During COVID, it was great because it was like a compound, right? We didn't have to go anywhere. Any other quick questions? Yeah. That was because I had never been fully convinced that hedging, which is, in other words, it's removing the Canadian US dollar exchange out of the equation. You pay a small premium for that. So what I did is I went to the Vanguard website and I looked at the 5-year, 1-year, 2-year, 5-year, 10-year returns of the hedged and non-hedged Canadian dollar denominated S&P. And there was a 3 to 5% difference measurable. Plus I had a gut feeling that so I was already kind of convinced that I was not going to hedge for much longer. And then, of course, we saw record inflation, record deficit in Canada, which is going to tank the Canadian dollar, which it did, right? We're now down. My wife's an American, so we send money to the US once in a while. It was 1.5. It was 66 cents. So 6 months ago, I just simply, all I did is I sold all of my hedged position in one transaction per account. And then I just bought the same amount of dollar-wise in a new unit value in the unhedged. So it wasn't really directional trading or speculation. It was simply that. I don't try to time markets. It was just something that I already thought of that I said, hey, it's time to get out of that. Any other questions? Very good. Yeah. I wouldn't transfer into USD. I would still buy it in Canadian dollars. Don't pay the exchange spread. Both the hedged and the unhedged versions of those funds can be bought in Canadian dollars. You're not paying the premium for the fund to hedge the exchange rate. So don't get hung up too much on that. The most important thing is buy a fund. Just buy the Canadian dollar denominated VSP.TO or VUN, one of those on the Canadian exchange. You can go to the Vanguard page and read all about those funds anyway. So that's cool. Online, we got thank you. That's great. Got a couple of AI note takers. Hi, AI note taking technology. Can we get the slides? Yeah, I will put a Dropbox up or something that will allow you to see the slides as well. So thanks very much, everybody, for coming. If you have any final questions, I'll linger for a second. But think about money. We don't talk about personal finance enough here. Hope you enjoyed the session. All the best for the future. Thank you.